Hi, this is Lex, and welcome to the FinTech Blueprint. It's your podcast about fintech, decentralized finance, digital banking, investing, robo-advice, artificial intelligence, and all the other frontier technology that is transforming financial services. To get more content, like an illustrated transcript of this conversation in your inbox, subscribe at fintechblueprint.com. So without further delay, let's jump into today's episode. Hi, everybody, and welcome to the podcast. I'm really excited for today's conversation with Luca Prosperi, who is an independent voice in an independent market. He's a researcher covering decentralized finance, financial services, has a really deep and interesting background in investments, and now works with some of the premier decentralized finance DAOs as well as projects in the space. Luca, welcome to the podcast.
Hi, Lex. Thanks for the introduction and thanks for having me. Excited as well.
Absolutely. We're going to learn a ton today. This will be a PhD level talk about how to run a DeFi protocol. But before we hop into that, can you talk a little bit about just your journey into DeFi and what you were doing before and sort of what the core realization was that pulled you into the space?
Yes, although it seems I've been working in the space for 20 years, it is actually less than a year. I come from a deep background in traditional finance. I was a consultant for banks and financial institutions, then an investment banker for banks and financial institutions as well, then a hedge fund manager and a private equity manager. So it's fair to say that I've seen banking and the way we intermediate value in many forms. During COVID, I was forced to step for a second and look back at my career and life because I was diagnosed with blood cancer. So I had to stop working, focusing on my life and the way, a good way to survive. I was lucky enough to come out on the other side perfectly healthy, but I've been 6 months of chemotherapy and isolation, and I think a great time to reflect. So when I came out of it, I'm making a very complex story simple, but when I came out of it, obviously, I wanted to have a higher impact and stop working in an institutional environment and try to help building the future of finance. And I was already playing with DeFi. I was starting to get involved with MakerDAO as a project that at the time was trying to onboard real world use cases into DeFi. And fast forward a year, I find myself ultra busy in many things. So I am trying to professionalize and scale what MakerDAO is doing in onboarding real world use cases. I am researching, working on my Substack. We can talk about it later if you want, and advising a few funds in the space and having great conversation with people much smarter than myself.
It's a really difficult story, and it's also a very profound story in that finding meaning or finding the texture of the world or wanting to change the world and wanting to feel the places and the edges where creativity is really flowing, sometimes takes a huge shock to start valuing that. And so I think that's really profound, what you've described.
I mean, just before starting, I just wanted to say that thanks. I'm grateful about my life. And I always tell this story because I hope that this story gives energy and optimism to the people that are currently fighting the battle that I have been fighting in the past. So I hope this can be of help to other people out there.
If we look at your entry with Maker and with real world assets, putting on your traditional finance hat, when you first encountered MakerDAO, what did you think it was? What was its purpose?
I saw immediately the potential of Maker because I saw something, the thing that was as close as I have ever seen to a new generation type of central bank or lender of last resort in the financial ecosystem. So I was looking at a protocol that was ready to mint, i.e. generate new currency in exchange for collateral. That construct was extremely powerful because it could have been applied to everything. And rather than, we always hear the story that we currently live in zero/negative interest rates environment, but this is partially true because there is a very long value chain between the lender of last resort and the users of that capital. And in the case of Maker, that value chain was squeezed into just a few smart contracts. So I saw the potential of really disintermediating the financial ecosystem right from the lender of last resort all the way down to the ultimate borrower.
What is a currency backed by collateral? I want to kind of zoom up one level, maybe to a philosophy view, maybe to a generic kind of capital markets pattern that repeats. How common or uncommon is this idea that you put things in a box and you issue dollars out of it? And how common or uncommon is this idea that the thing you get out is pegged to fiat currency? How should we relate to the financial instrument itself? Like, have you seen the particular financial instrument before?
So I think, first of all, there are a lot of similarities between so-called stablecoin, i.e. a coin that is minted in exchange for collateral, and the currency we're used to have in our pockets. The difference is that the banknotes that we used to have in our pockets, now we have in our bank accounts, they work so well that we ignore the complexities behind the scenes. I typically say that I love currency as a product because it's the most sophisticated product there is philosophically, I think, out there, but also the most mass utilized and mass marketed. And it works so well, people ignore the complexities behind it. So I think if we have a parallelism with the dollar fiat world, it is very similar. In a fiat world, there is a borrower that pledges some sort of collateral to a bank. Now, the collateral can be hard collateral, i.e. a house for a mortgage, or soft collateral, credibility, credit score, personal history, or personal guarantees, or intangibles of some sort, and receives money that is minted, created by that bank. So the dollars we have in our account are not the dollars that are created by the central bank. This is a credit claim on a commercial bank. Now, it works so well, the system, that we think it is 100% safe, but it's not. Unfortunately, we are seeing it recently with the current bank runs we have in the geopolitical landscape. And the commercial bank on the back end does the same with the central bank. So they pledge the highest quality of collateral they have to the central bank. And the central bank acts as a sort of like guarantor to the whole system. And when things work, everything flows smoothly. And the Maker construct, it is very similar. The difference is that the ultimate borrower can access these discount windows with the IE central bank, that is Maker, and receives DAI, which is the Maker minted stablecoin in exchange. But I think the last comment here is that I think this is very early days. So we are accessing the mainframe directly simply because the construct is very immature. In the same way we are currently trading on the Ethereum layer 1, and probably we will not touch that layer in the future. So I envisage that this value chain to get longer and longer so that the ultimate users of capital will not access the discount window to the central minter of stablecoin, but actually will relate with intermediaries in the middle. The concept is not new and is actually very powerful.
Yeah, I have a couple of talking points or places where I tend to get stuck around stablecoins. And I think, we'll talk about Curve, we'll talk about DeFi 2.0 and the Olympus model, maybe time. So some of the longer tail stuff in a minute. Some questions that I'm sitting with that continue to be like unresolved. And I don't know if I've just gone sideways and gotten stuck on them or if they're profound. So, the first is, yes, there is this idea of, the money supply M1 or M0 versus M2, and M2 has all of these kind of bank issued credits that we all carry around, and that's something like 2 to 3 times the underlying fiat from that's actually gone out and gotten printed. And so to some extent is just leverage. And then when looking at this in the crypto context or the DeFi context, like it's not clear to me if it's leverage or if it's payment, if it's currency for consumption and for purchasing things, or whether it is more akin to, you go to an investment bank and you want margin exposure, so you give them a bunch of stuff and they give you a loan at an interest rate. It's not entirely clear to me, like this idea of the central bank versus this idea of I'm interfacing with a capital markets desk and I want to go long or short beyond just my position. So that's kind of like one thought. And then the second thought is deeper on this like use thing, where in Web3, the rails for different financial industry primitives have all been collapsed into one computational paradigm and then sort of pixelated and glitched and compressed to such an extent that it's some very simple functions that exist in the same place because they have to be processed by the same kind of global computational engine. And so instead of having the card networks intermediate the purchasing of a coffee and then Fidelity intermediating the purchase of a money market fund for different purposes, you instead have a single instrument, the crypto dollar or the stablecoin or the cash equivalent, that I think people are still confused about whether it is for the cash position in a portfolio or whether it is something that the implication is you spend it in order to buy stuff. I'm curious just to get your sense on those questions. And then, to the extent that Maker articulates a vision, like how does it parse through these different things?
That's obviously the core of the question here. But the way I see this is going back to what I was saying before. I think the currency product, the currency philosophical construct in our daily life, it is awesome because it does a lot of complex things all wrapped into one. So we ignore it. We can use it. Different people, different agents can use it for different reasons. You can use it as a payment system. You can use it as a storage of value. You can use it as a unit of account. We always have these three definitions, but I think the fourth one is the most important, which is an allocation of purchasing power and allocation of value. So we tend to allocate our time where, in general, it pays the better price. Now, in the traditional world, we look at a currency as a single construct. We are expecting a currency to do all those four aspects very well. It doesn't need to be, and actually, in reality, some currencies do some jobs well and others less well. In the Web3 ecosystem, I think, as in many other use cases, we have had the possibility to decompose those activities, those ambitions into different subsets. So we are trying to have one currency that can rule them all because we're used to that, but it's not necessarily the case. So we might actually land in a position where we have certain so-called stable coins, although I don't like the term, certain stable coins that are very good at doing some things like payments, and others that are good at allocating purchasing power or accessing leverage. Others that are good at storing value because they're very decentralized, etc. And I think that is why it is difficult for us, because we are trying to replicate the use cases we're used to in the real world into the new ecosystem that is augmented by the technological capabilities we have. I think this is why it is complicated for us to grasp all those monetary experiments that we see out there. And you touched briefly on Olympus, Time, DAI, RAI, USDCs. We have many. And I think a currency is a great wrapper, but then I love to dig a bit deeper to understand what is actually a currency trying to achieve. Because I think this is important for any investor or user to understand what is the best way to use a currency or another.
I'd love to double click on Curve, maybe as a next stop. And in particular, this period of the Curve wars and what impact that's had on the DeFi market structure, as well as what kinds of things that, we're seeing grow out of it. But maybe if you could just start with the definitions of what is Curve, what function does it serve, and how do people use it?
So Curve, and I'm not necessarily an expert of so-called automated market makers, but Curve is a venue where actors can swap assets one against the other in a very efficient way. So the reason why Curve was born was that back in the day, where the main so-called automated market maker, which is an automated venue where people can exchange assets, was Uniswap. Uniswap was working relatively well, but required a lot of liquidity to have little slippage. So let's step back 1 second. It means that if I have asset A, security A, and I want to swap it for security B, there needs to be in this platform a vault that owns the same amount, the same value of A and B, and I can go in there, I can interact, and I can swap A for B. Now, for this vault to work, and because of non-arbitrage assumptions, this vault tends to work very well. So when there is more A than B because people actually want B, there is a rebalancing phenomenon because the arbitrageurs, they enter and they buy cheap to sell at market outside and clip a profit. To have this AMM construct work well, there needed to be a lot of liquidity to avoid slippage, meaning inefficiency in swapping one asset for another. Now, Curve had an intuition, and their intuition was to land on a mathematically less elegant solution, but that would have worked very well if the assets were typically moving in sync. These were the days when the so-called stablecoins were blossoming. So stablecoins were crypto securities, crypto tokens that were by construct pegged on an external valued asset. Now, the most common asset to use for the peg was, surprise, surprise, the US dollar. So if you have stablecoin A and stablecoin B that are both pegged to the dollar, obviously they tend to move in sync one against the other. And they were a perfect use case for the Curve AMM type. And that solution resonated. So Curve amassed incredible amount of value immediately because the people who wanted to swap a currency for another, both pegged on the same security that was the dollar, were using it in a much more efficient way than Uniswap.
Why do you think people wanted to go from one stablecoin to another? What's the underlying business activity?
I think this goes back to what we were saying before. I think a year ago and today, we have many stablecoins coexisting. So there are many experiments that are based on this construct of a currency. We can go into the details later, but obviously the basis for this experiment to work is that you can actually use a coin fungibly to do other stuff. So you might want to use one coin to do one thing, i.e. to access leverage, but then that coin is not widely used to exchange value in the ecosystem, or is not the best platform you believe as an investor to store that value in the long term. So you actually want to use coin A to do activity A and coin B to do activity B. So a platform like Curve facilitates this fungibility of the stable coins one against the other. And that's why it was very successful. To make an example, USDC, so the Circle facilitated dollar. So Circle is a company, and you can, in simple terms, you can deposit real dollars in a money market fund, and you receive a crypto version of that dollar that is called USDC, and you can use it in the ecosystem. It's probably the most efficient ramp if you want to bring liquidity from the off-chain world onto the on-chain world. But then if you're an on-chain user, you might decide to store that value in a different coin. For example, the maker-backed coin that is called the DAI, because it's more decentralized, or because you like it, or because actually it is accepted by more businesses, or because it has a higher interest rate and you want to carry trade on that interest rate. So there are many reasons why you might be in a position to prefer one coin to do one activity and a coin to do another. And you need to swap those in significant amount in a very smooth and slippage-free way.
Yeah, I think there's a broad market structure comment there too, which is, to your point, the yield on different dollar-pegged currencies is different. And it is because the underlying risk profile of each one of them is different, and they might have different mechanisms that try to achieve stability. Some might be just like USDC backed by stuff in the traditional finance system. And then others might be backed according to some ratio the way Maker does it. And then others might have sort of a labyrinthian set of incentives that are trying to programmatically adjust the value in some way against some equity-like instrument and so on. And it's a little bit more hopium than or I guess the assets that are backing it are less hard and much more early stage equity like. And so you have really different versions of the crypto dollar. And because of that, you also have really different opportunities and schedules to do emissions and rewards. So some projects might be very stingy with their yield farming, and for others, it might just be they're printing it out of thin air. And so the real interest rates might not be high, but the nominal interest rates are quite high. And then on top of that, you've got the markets across Compound and Aave and other sort of markets for leverage, the borrowing and lending of these particular things too, and they have different equilibria and generate different interest rates. And so Curve to me was like a way to almost like average in all the risks, So if you've got a pool that holds USDC liquidity and then you're happy to take the Tether risk, or you're happy to take the Luna Terra risk, or any other one, like a pool that combines these things and then has $500 million worth of value almost gives legitimacy or pegs these things next to each other, because a lot of the mechanics were about, if you're putting your holdings into the pool and you're getting incentives in the various currencies in the pool, often you're also doing it over a long-term time frame. You're almost committing not to trade out of the jankier asset, and you're averaging in the credit quality. Does that make sense to you? Does that resonate with how you see the world?
No, it does, definitely. I think there are many reasons why somebody might want to borrow or lend an asset. Borrowing an asset is a way of shorting that asset as well. There are many reasons why an agent would like to use a platform like Curve. And I think that the best example that is not actually a stable coin, but is the best example to what you just said, is the Ethereum staked Ethereum situation. So we know that Ethereum as a blockchain is migrating from a proof of work to a proof of stake. And you can start actually staking your Ether if you have enough, but you cannot unstake those Ether tokens for a long time until the migration is complete. So if you want to get the benefit of most of the staking yield, that is, let's say, around 5%, you can do this in liquid form, i.e. you can stake your ETH with an intermediary through a protocol, a permissionless protocol. That intermediary would stake it, and you will receive back a staked version of your ETH that you can use in the ecosystem. But if you want to unstake it, you cannot. But you can swap it back with somebody else. And given that the ETH and staked ETH are based on the same security, they have a very similar value. They're highly correlated, and they're perfect assets to be traded with a Curve model. So you can use a Curve pool to move between staked ETH and ETH and get the benefit of liquidity of one, or the benefit of the yield or the other.
Right. Makes sense. So how do we extend these fundamentals to convex and the curve wars? What happened with these longer dated sort of commitments in order to gain the reward? And what did the industry figure out they could do to the protocol?
So Curve, first of all, was extremely successful. So it attracted a lot of liquidity. And when you have a lot of liquidity, you have a lot of power. So I joke that, it's like being a very famous celebrity and suddenly you have a lot of friends around you. The way Curve understood they could leverage this power was by incentivizing people and agents and protocols to stick to the Curve protocol for as long as possible. So how did they do it, and what happened afterwards? So in Curve, as we were saying before, you can pledge a certain asset in a vault and receive a yield, which is a percentage of the transaction fees that are generated within that vault from agents that are trading one security against the other. But then that yield is augmented by farming that is sponsored by Curve itself. So if you park your liquidity for long enough, up to a certain number of years, you receive more tokens of Curve. Now, the tokens of the curve tokens, they also give you ability to influence the protocol itself and to allocate the awards to your own vault. So it is recursive. The longer you stake, the higher amount of liquidity, the more power you have actually to influence the curve protocol to give yourself in your liquidity vault even more incentive. So it is recursive. There is a convex incentive for people to stake a significant amount of money in a vault and to stake the incentive tokens they receive for as long as possible. So it is recursive. And it's not surprisingly that the protocol that built on this recursive mechanism was actually called convex. So if you can have, say, convex incentives in allocating liquidity and staking incentive tokens for as long as possible, then you can actually bribe somebody like a source of liquidity to give you as much liquidity as possible to do exactly that work. So, and then you have a curve square. You have people that are creating the same level of incentive on top of curve, giving the same types of incentives to people that give liquidity to convex, that then gives liquidity to curve, that then gives liquidity to the users. And as you can see, there is no limit. You can go up the pyramid as much as you want, and you can offer more and more incentives because the first people who wins the race gets the largest amount of rewards. That was the way Yearn was born, Convex was born, and other layers. We can go as deep as you want, but other layers were created to benefit from this. So I think ultimately the success of the curve system developed an ecosystem, a vertical ecosystem around it of people that wanted to access the liquidity and access the rewards that were provided to the liquidity providers themselves.
What's the current state of the world? There's been a lot of activity by the founder of Yearn, Andre Cronje. There's been stuff on Phantom. What's the current state of this part of the space?
I think at some point the system becomes intoxicating because ultimately the food chain, you need to innovate at the base. So you need to make sure that the curve layer is working properly. And the system, the pyramid is getting so stretched that actually agents at the top of the pyramid are getting worried whether they will be able to get the rewards they were expecting when they enter the game. So we were saying that before the curve was born because of the inefficiency of Uniswap, that was the big daddy of the automated market makers. But obviously Uniswap and others didn't stay idle and they innovated themselves. So protecting the competitive advantage that you have as an efficient AMM is more and more difficult. That has an impact at the higher level of the pyramids because every layer of the pyramid is de facto increasing operating leverage based on the base. Without getting into details, you can have intuition that ultimately you need to generate value to receive value, to keep receiving value in the long term. Otherwise, you're simply moving liquidity from one pocket to the other pocket. The ecosystem started stretching this pyramid in a phenomenon that was renamed the curve wars, as you were mentioning at the beginning, using more and more powerful ways of bribing liquidity. So Yearn was the first meta layer that was built on top of curve and used similar incentives, although with a different spin. Convex was another one. And then we started seeing an interesting phenomenon that was when a construct was created for a different reason, a different use case, was actually utilized in this specific condition. So this was the case, for example, of Redacted Cartel, where a group of developers used the Olympus created incentive system that is different from the convex and the curve ones to actually hijack the liquidity on convex and the liquidity on curve as well. So we are starting to see these hybrid structures where people are experimenting and merging successful ways of porting liquidity from one place of the DeFi ecosystem to the other. But ultimately, all the castle will fall if the innovation doesn't continue at the base. And the hungrier the layers of the pyramid become, the more difficult it is, obviously, to keep them happy.
One of the macro ways to look at it is if you just slice up the overall crypto market cap of 3 trillion at the top, 1.5 trillion here and there. From an asset allocation perspective, what do the assets mean? What are the sectors that the assets participate in, and what do they produce, and so on and so forth? And DeFi is somewhere around maybe 200 billion, give or take, with Ethereum being 3 times that, and with Bitcoin being 2 times that, and again, roughly in terms of numbers. And so your financial sector, which powers up all of these various investment functions, your financial sector is always going to be smaller than the economy that it's powering, because it's just a derivative. It's an outgrowth of that economy. The only way for the thing to grow bottoms up is to actually have a thing that grows bottoms up and is a digitally native Web3 that generates economic activity. I think is one of the reasons why performance in the DeFi protocols hasn't really kept up with performance in the hype of Web3, the hype of NFTs, the more kind of like crafts-oriented parts of the industry. And I think that's okay, because you need to grow that stuff bottoms up in order to get the rest of it to follow. But I'd like to use that as a transition to talk about Olympus. And you talked about, moving money from one pocket to another. Olympus and its even riskier cousin, Time, has a reputation of sitting between like a Ponzi game and a legitimate innovation for bootstrapping protocol liquidity. How do you think about Olympus? What does Olympus do for you? To the extent that it still exists, what do you think it is?
It does exist. I actually just wrote an article last week about Olympus, the second article dedicated to Olympus on my newsletter, although I touch on Olympus several times. I try to remain as open-minded as possible in my research. And I've had a love and hate relationship with Olympus since the beginning of the project. I started looking at it thinking it was simply a Ponzi scheme. Then I understood that there was some value in what they were doing, but the speed and intensity of the phenomenon was definitely unsustainable, and also the prices were unsustainable. I stopped paying attention when reality caught up, but then I had to go back paying attention because I realized that Olympus is not a monolithic experiment. It is actually a monetary startup that is traded live from day one in the open markets, and hence is very erratic, but it is extremely fascinating. And we can go into the details also, the most recent developments if you want. But I still believe I'm never invested in the Olympus or most of the forks, the copycats, but I still believe that Olympus is probably the most relevant monetary experiment that we have seen in DeFi since the beginning of the DeFi so-called summer.
There's a bunch of mechanisms that we'll just check off, right? I think what's challenging for me is that there's definitely innovation in the mechanisms, and some of them are quite compelling, but the way in which they are together and then how that overlaps with the marketing story is very Frankenstein, So there's a really interesting mechanism of bonding, which is essentially issuing your own equity in order to purchase an AMM position, a market making position, which is half in your own token and then half in some other currency. So you are levering up and acquiring a different asset, but you're using that through an issuance of your own token, and then you're doing it in such a way as to give people a short-term sort of interest rate return denominated in the currency that you're issuing that can resemble a bond. And so people will hit the incentive to get the extra 5 or 10% in a very short time frame, but in essence what they're getting is they're buying the token through sort of a almost disguised mechanism by first committing their capital into an AMM position and then trading that in. That I think is compelling, especially in this broader narrative of protocols suffering from having to yield farm and do yield farming rewards and having to bribe people to just be able to offer their tokens out. I think there's a separate and different mechanic, which is the nominal inflation rate in the protocol is so astronomically high, achieved through like a rebasing mechanism, that to avoid that hyperinflation, most people are incentivized to stake and receive the sort of like absurd interest rate. And most of the narrative and the conversation is actually about this kind of like crazy hyperinflation rate. And I think it traps a lot of people into thinking that they're actually getting a real return rather than, a nominal return. And there's sort of a crazy leverage spread or just a meme spread between the price of a token and the collateral backing the token, which is acquired through, these bonding mechanisms or otherwise. And so I was always kind of confused as to why that part of the story was designed or written in such a way as to be, perplexing to the average user. So maybe I can pause there. And of course, the final bit is that Olympus has opened up some of the things that it does to third parties, enabling this like the acquisition of protocol controlled value, which I think is one of the more interesting operating things that the project can do. But let me pause there and see if that, again, fits with your conception and where you think they're going, what went wrong, and how they're fixing the stuff.
Yeah, because I think actually the most fascinating aspect of Olympus is quite a recent one. The community, in the name of Zeus, that I believe is not the person's real name, released a white paper about potential evolution of Olympus, I think a couple of weeks ago. And that paper, I do not exaggerate my reactions, but that paper blew me away. But we can go into the details later. But I think your points are all relevant. And at the beginning, Olympus was bootstrapping and trying to attract liquidity as quickly as possible, offering these nominal meme-like rates of 1,000% or 5,000% a year to people. De facto, they were nominal rates. They were paid by an inflation of the token, so the real rate was as close to zero as possible. And disincentivizing people to simply sell the token. So they were trying to create an incentive mechanism that was attracting value within the protocol and keeping the native token very liquid. So they were giving incentives in the forms of bonding incentives, as you were referring to specific assets they want to attract, typically stablecoins, and to specific liquidity tokens, LP tokens, they wanted to attract to incentivize the system to keep the native token liquid. So they wanted to create a diversified treasury, so a diversified stablecoin backed asset or meta coin that was very liquid in the DeFi space. But then obviously, as many times happened, because the abundance of liquidity that we experienced last year, things went out of control. And when I wrote my second article about Olympus last week, I did some comparison between the October situation and the February situation. So in October, in the 14th of October, I have the numbers in front of me. Olympus market cap was more than $3.5 billion, 3,650 million. And fair value of their treasury, so basically the valuation of all the tokens that were attracted in the treasury book, plus half of the LP tokens, because we saw that the LP tokens is actually the liquidity pools are half the native token that should be discounted and half another token. So let's take 50% of it. So the fair value of treasury was 280 million. That means that the market to fair value multiple of Olympus was more than 12 times. It means that the market was giving a value to Olympus that was 12 times the value of the tokens that were on the treasury.
That's like only a third of Goldman Sachs in 2008.
But first of all, we knew how 2008 ended up, so it's actually a good reminder. But then what is also fascinating is that most of the treasury of were not assets that had the potential to generate incredible yields because they were stable coins that by definition have no yield. So why was the market giving a multiple of 12x to a protocol that was owning mainly yield-free coins? There can be many reasons, and the reason is that if you end up having the reserve currency of the world, this reserve, being the reserve currency of the world, like the dollar today, has a lot of value. Does it have enough value to satisfy 12 times multiple? Probably not. Probably there was a lot of speculation. So fast forward February 23rd, that multiple now is 1.4. So the market cap is 600 million. The treasury is actually 360 million. So that market to fair value multiple that I calculated was 1.4. So suddenly it becomes a bit more interesting to have conversations, right? So can we justify a 40% premium on market valuation in a project? It is easier to justify a 0.4x premium than a 12.5x premium. But then where does this premium should come from? And there are many ways Olympus is trying to monetize and create value based on the ecosystem and liquidity they have generated. Before giving you back the word, I mean, I referred a white paper that blew me away, and I just want to give the insight on this white paper. And in the white paper that was published within the Olympus community, they were suggesting the creation of another security as part of the Olympus ecosystem. So we had the staking mechanism that you mentioned. We had the bonding mechanism, and they were introducing the inverse or internal bonding mechanism, a way to give back Olympus tokens and receive assets in fixed expiration terms. So I'm not going to go into the details, but the indirect effect of this innovation is to create within Olympus a fixed income market. So a market to trade real rates in DeFi, something that has never happened in DeFi yet. And actually, I think is one of the biggest limiters for the institutional adoption of DeFi. So I think it's a good example of how you can bootstrap very fascinating and complex use cases out of a project that originally was born probably for a different reason.
That's fascinating. It's like, the diamond being etched in the volcano under insane pressure, which in this case was like 90% and more price collapse. But to reinvent an industry on the back of it is pretty cool. I would love to keep going in our conversation. Unfortunately, we are at the hour. Luca, it's been fantastic having you on. I'm sure we'll do more. If our listeners want to reach out or to find you, where should they go?
First of all, thanks. I hope we'll have many conversations like this. It's always exciting. So anybody can reach me on Twitter. My name is Luca Prosperi, and my handle is @Luca Prosperi on Twitter. So it's very easy. As I mentioned, I write a newsletter that cost me a lot of sweat and tears and long nights, but I'm proud of it. And it's called Dirt Roads. So people can read my articles on dirtroads.substack.com. And looking forward to receive many messages on the topics we have discussed and many others.
Absolutely. Thank you so much again for coming on the podcast.
Thank you, Lex.
Hi, everyone. That's it for this week's episode of the FinTech Blueprint. For more technical deep dives into all things fintech and decentralized finance, check out fintechblueprint.com and grab a free subscription to the newsletter. This is Lex, and I'll see you next time.